Let me be the first to tell you, even as someone who's called the perma bull of YouTube, that Friday was bearish. On the surface, everything looked just fine. There was a nice pre-market rally and even an end-of-day rally, as literally $5.3 trillion of notional value expired on the quad witching. But under the hood, wow. There was actually much more net selling pressure at the exchange level, and value did not shift higher with price into the close. Quite the red flag. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan noting this bearish divergence. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 5 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we have a green-bodied hammer-esque style bar, and it's important to note that it is a green body because, of course, the lower wick would imply that sellers stepped up at one point, aka the FOMC, but buyers clearly responded and moved prices back up to the opening print, but they didn't stop there. They moved through the opening print for range expansion in the upward direction, and they did achieve a fairly strong close in the upper third of the weekly range here, so structure is absolutely bullish. If we're thinking about location on the bar-to-bar count, a clear higher low, as well as a higher high and a candle close outside of and above the previous week's range. That's 2 for 2 on the bar-to-bar count. Buyers are in control. Obviously, this is a brand new all-time high close as well, and I want to be abundantly clear that although there is a subtle divergence on the bear side on the Friday session, the weekly timescale is absolutely bullish. There's no issues here from a trend reversal perspective. The other thing I'll point out is that some folks consider this candle structure, a hammer at the high, a hanging man for a reversal. I would just point out, here's one that moved higher. Here's one that moved higher. Here's one that moved higher. Oh, look, here's one that actually moved lower. So at the Trade Brigade, we take all candles at face value. And in my opinion, the lower wick would indicate that buyers stepped up and there was a strong close at a brand new higher high. If the weekly chart takes out the previous week's low, I'll start to change my tone. Notice how here, when we took out the low of the hammer candle, great, maybe we're starting to drift into a downtrend. We don't have any evidence of that yet, but you could carry forward the low of the weekly bar. But hang on, let's stop for a second. What do we know about what was happening back here? This was an equal high rather than a higher high in the trend count. This is the highest high in the trend count, and therefore, is it reasonable that if the market pulls back, could we seek some kind of higher low on the higher timescale? I think the answer is absolutely. And if you've been tuning into the past couple of weekend videos, you know that we're still interested in the previous all-time high from back here, but we're also starting to carry forward this level here. Previous resistance can now act as newfound support, and that would absolutely qualify as a weekly higher low. So no problems from the weekly trend perspective, regardless of if you want to call this a hanging man reversal candle on the weekly. We're still dealing with an opportunity to set a weekly higher low, even if a pullback were to emerge, which at this point, there's not an overwhelming body of evidence on the weekly that would suggest that's the higher probability outcome. If we come in here with the anchored VWAPs from major inflection points on the weekly, we're above the entirety of the stack. There's no issues from an anchored VWAP perspective here. If we come in with our Fibonacci from the low, just curious, now that we've made a higher high, how does the 38.2 stack up to the previous all-time high? Not quite there yet. Remember, the higher the high gets, the more likely it is that we'll get confluence out of the Fib 38.2 at the previous all-time high. We're not there yet. Let's come in from the low of the China gap up to make the deal to make a deal. Let's bring this one out. We've got the Fib 38.2 just a hair underneath this spot in here, which FYI is about 640, 637. If we're above that for that weekly higher low, we're certainly well above the Fib 38.2, which would qualify as bull flag consolidation. Really not concerned from this perspective. If we take out the volume profile on the weekly, of course, as we sit on new all-time highs, basically, there's going to be no volume shelf above the target as resistance. But if we just bring out this high volume node, which is the highest volume node after this one, which is the previous all-time high shelf practically, that is this one, confluence with that 637, 640 spot we were just talking about. So are there any issues here on the higher time frame? I want to be abundantly clear once again that although there is a subtle bearish divergence on Friday's session alone, there's nothing dramatically on the weekly time frame that is shouting at us saying, hey, watch out, there's going to be a weekly trend reversal. We could get a pullback and we could still set a weekly higher low. So the perma bull of YouTube still lives on, and we'll drop this thing down to a daily timescale chart. What do we see on the daily perspective? First things first, weekly expected move. What's going on? Where's the upper edge? Let's get it on the screen. There we go. Expected move is this gray box right here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, it's a brand new all-time high, a higher high in the trend count, and that is at 672.35. If we're contained by the lower bound, the number's at 655.05, and that's sort of an equal low to the FOMC low, but if you watch the Wednesday update video, late at night on Wednesday, then what we were talking about is that intraday, we just had volatility on Wednesday. We didn't actually fall into an hourly downtrend, so I would call this a soft daily higher low, and even if we were to retest it, I would still consider it a higher low in the daily trend count, because at this point, I would assume, and maybe this is a bad assumption, assuming does, but I would assume, I think it's a safe assumption, if we were to navigate down towards about 654, 652.25, it would be very likely that we would have to flip into an hourly downtrend to get there, and that would qualify our firm daily higher low. So I'm still bullish here from an expected move perspective, and a daily trend perspective. We have lows, we have soft higher lows, soft higher lows, soft higher lows. We have not fallen into an hourly downtrend through this entire advance here. Because this gapped up to a higher high, there's no way, there was no lower high there, right? These two back-to-back inside days here did not allow the hourly trend to flip to down. So all things considered, once again, there is no firm higher low ever since this low. I'm not going to say that, I'm not going to align with this, but is it technically possible that you could get a daily higher low over 642.50? Yeah, I'm not going to stretch that argument and go to that point. I think that there's going to be much more of a threat that if you were to get here, there's some sort of lower high complication in the future. So I would not like to see a daily higher low there, but is it possible? For the sake of being technical and nuances, yeah, of course it is, right? So let's just reel it back to reality here. Where do I actually want to see a daily higher low persist if the market is going to pull back? It's this zone, right? It has not changed from Wednesday. It's the daily 20 SMA. It's the previous resistance point here. It's the opening print of the Thursday rally from what was now 2 weeks ago. It's the FOMC low. It's the lower edge of the weekly expected move. It's this zone right here. On the daily time scale, any pullbacks, any bullish consolidation that's going to persist, I would love to see it over 652.25. That's the sweet spot for me. There's another nuance here that I want to talk about before we start talking about candle structure, which is the extension over the daily 20 SMA. We were starting to talk about this with the group the other day, and if we just come in here, I actually coded this up. Let's say distance from 20. Let's throw this on, and I'm just going to get 3 years of daily data here, just so we can see a normal extension. Like, when does the market start to top out in terms of extension above the daily 20? You could see, and not that, this is not, you don't apply analysis to this chart, technical analysis, but you could see that normally you might get somewhere extended about, 13, 14 points from the daily 20 SMA value. And you could see that we're currently right around that spot. Now, it doesn't mean that the market has to come crashing down and, oh my goodness, the market's overextended. We never, ever take that approach in trading. The market can always remain, what do they say, more irrational than you can remain solvent, right? So that's not the approach we're taking. But what I would say about the market here, considering what we've just talked about with that daily 20 SMA extension, and as we'll see with some bearish divergences when we look under the hood, I would just be super mindful of your trade location up here with new money longs, right? If you're really starting to put the pressure on and, pile into longs at the highs, I think you're just exposing yourself to way too much pullback risk. So we're not just changing our tone to being bearish and, oh my God, the market's going to crash because we're extended through the 20. It's just, let's be a little bit extra cautious about new money longs entering here at the highs. Now, in terms of candle structure, we do have a bullish inside bar. The reason I would call it bullish is just because you can see that we made equal lows relative to the Thursday low, which are roughly aligned with or even above the Monday, Tuesday, Wednesday highs at 661.50. So really no issues with that as the market balanced off on Friday. One thing I would carry forward here, it's different in the ES, but it is unrepaired in the Spider's cash. You have an overnight all-time high that's unrepaired at 665.15. If the market is going to move higher towards the upper edge of the weekly expected move, it would inherently repair that. You want to see a new all-time high in the regular trading hour session, not in the after hours. So we're not ignoring price action. Price action is a bullish inside bar here at the all-time high, but if we take a look, we'll save the internals for just a second. Let's go to the hourly first, actually. Let's go here. What do we see on the hourly chart? The trend remains in the upward direction. There's really no issues with the hourly trend. You have a very clean sequence of lows, higher lows, higher lows, higher lows, maybe even higher lows happening here, higher lows happening here. I think the argument would just be any bullish consolidation happening here is inherently bullish. It might correct the bearish divergence we're about to go through. If we get this, it's just Brigade bolts into blue sky territories, mindful of your trade location, right? Being respectful that you're sort of, I wouldn't call this chasing necessarily at the all-time high, but you are getting involved where the pullback risk is elevated, as we've just seen. If the market is going to develop a double top, and everybody will call it a double top in hindsight, and that'll be great and dandy and whatever online, but remember, it's not a double top until it is. At bare minimum, you'd have to be underneath the neckline here at 660.65, but do I even want to be short under 660.65? Too many sixes. Absolutely not. Look at this consolidation and the chop and slop from Monday, Tuesday, and Wednesday ahead of the FOMC, even some of the noise from FOMC. I don't want to have anything to do with shorts inside of that range there. I would much prefer to wait for shorts back underneath the Friday low of 2 weeks ago, which is 657, trading back down into the FOMC low and the daily higher low zone that we just mapped out on literally the daily timescale, 654, 652.25, this zone in the box that we're highlighting here. If the market comes into this, I am absolutely interested in possible reversals out of it to set that daily higher low, respect the daily 20 SMA, reset the distance to the daily 20 SMA, and then we'll carry on from there. If we have to reevaluate and change our tone, it would likely happen when and if there's a large breakdown. Let's say that this happens like this and it builds out, not only could it be double top 1, 2 here, but let's just say it turns into a head and shoulders as well, and oh my god, everybody gets all bearish. If we get something that looks like this, okay, a failure of the daily 20 SMA, right, as in if that starts to look like that, underneath that daily higher low zone, suddenly the pressure might be on, from the weekly perspective, seeking that 640, 637 level, which exists down below. And lo and behold, what's down there? Your daily 50 SMA, the blue moving average on the screen, right here, down towards the bottom. So that's how I see the trend progressing if it's going to change in a major way to the downside. But until proven otherwise, this is bullish consolidation. This is Brigade bolt to the upside. Please be mindful of trade location. If we get this, I don't want to be short here. I really don't even want to be short here. Maybe we'll be short underneath 657 for scalps only into the daily higher low zone. Then we'll reevaluate as we've just mentioned. The next thing I'll point out is if the market opens on a gap up on Monday morning or even Tuesday morning, we open on a gap up, that's again where I would start to become extremely cautious of chasing the market on these highs, right? We've seen this time and time again. There was the intent for a gap up on the Thursday morning session. It was actually looking really, really strong, and then it sort of faded away into the open. But as the market opens historically, right, you could see this here, you could see the gap up here, you could see the gap up here. As we've been gapping to new highs, the market has been fading. Right? You even got a little bit of that on that Thursday morning session before then getting the rally. So please be mindful that if we open on the gap up and you're extended through the daily 20, we're talking about this extension towards the all-time highs and sort of being cautious of that trade location, I wouldn't really chase a gap up on a Monday or Tuesday session here. If we take a look at the anchored VWAPs intraday, what do these have for us? Any confluence on these? The pink one is the FOMC anchored VWAP. This is right here at what could be considered the double top neckline, right around that 661.50 spot. Aside from that, these are the major spots in the most recent development of the uptrend. From the gap down here, that was the labor report, right? This was the gap up that then followed it up. Here we go. Like all these major inflection points, beautiful confluence here. This is right towards, it will be early in the week, that 652.25. So if there's liquidation break, if we find ourselves here on a Tuesday, for example, that would be, in my opinion, a decent confluence with the anchored VWAP from this session way back here, right? Let's go ahead and move into, what do we want? Fibonacci's intraday? Absolutely. Let's just try a little of these and see what's going on. So the first thing we'll take a measure of is from the FOMC low to the all-time high. Let's go from here to here. Perfect. So what would I point out? It's really that the 61.8 is confluence with the unchanged price from FOMC and really where I would start to make a little bit more of a bearish shift in my tone. So I think that that aligns beautifully when we're just measuring from that FOMC. Let's clear that up and let's take a look at our first major bearish divergence. It's over here in the market internals. If you're not familiar with the market internals, check out the video tutorial in the top right-hand corner. So what is the issue? On Friday, as the market rallies into the close, you actually have bearish volume flows, you have bearish advanced decline line, and you have bearish cumulative build. So all things considered, at the exchange level, this would indicate a weakness in breadth, not broad-based participation, right? That's sort of one and the same. And just at the exchange level, some skepticism as all of this expiration is taking place for the quad witching. Now, it's 1 day's worth of data points, and it is sort of a special circumstance with the quad witch. So what's the actionable takeaway from seeing these internals not confirming the upside move that we saw on futures? I would say, once again, this circles all the way back to what we've talked about in the S&P 500, where if we gap up on Monday, I would be extremely cautious of chasing longs into brand new all-time highs when the posture at the exchange level really does not support new money buyers getting active on that rally higher into the close. To me, it is much more of, sort of like I don't want to say fun and games from market makers and such. That's never the perspective I want to take here, but it's the nuance of the OpEx, right? And all of the just different rolling over of positions that's causing this disruption, this disjoint between what's happening at the exchange level and actual price action in the ES futures. So giving it a day here to reset and not coming into the Monday session being overly gung-ho, just longing things blindly at the all-time high makes a little bit of sense to me. Now, I said in the introduction, right, that Friday was bearish. This is what I mean. It's not bearish enough where, oh my God, we need to short the market and everything's going to crash and burn. It's let's just take it down a notch on how enthusiastic we are about being bullish at the highs when we're starting to recognize this divergence. That's the main takeaway, right? Let's get on over to the market profile because this is where there's another subtle bearish divergence. Now, we are looking at the Z contracts. You should be on the Z contracts. If you're not familiar with market profile also, check out the video tutorial in the top right-hand corner. What I want to point out, and I use a 4 o'clock close. I do not count the 4:15 session or the 4 to 4:15 session on my futures market profile. Look at how the value area here is unchanged, right? It's like engulfing, yes, but I mean, maybe a little bit of drift from the point of control. You're still inside of, right, that Thursday range. So value did not, shift higher with the end of day rally that we saw in L&M periods in the futures. So that's a little bit of a red flag there. You have a double distribution. You actually have sort of a triple distribution. You could count this as a string of single prints, this as a string of single prints. So all we're going to do on the Monday session, and you also have a spike up here at the high. What we'll do on the Monday session is, do we open, let's just call it two distributions, right? Let's call this one distribution 1, this distribution 2. Do we open up here? If so, buyers remain in control and we won't be aggressively bearish. If we open in here, which seems a little bit more reasonable considering where value was, then we'll just remain a little bit more neutral. Again, not outright bearish, but we'll be a little bit more neutral, a little bit more hesitant on that upside as the market has found fair value and is more comfortable distributing contracts, right? That's really the goal if you subscribe to auction theory, right? The market should find the price point where it can be most efficient in distributing, buying and selling, facilitating buying and selling of the most contracts. So in value, in range here, I would just remain somewhat neutral as price accepts there. So it's not bearish, again, in the sense where, oh my God, the market's going to crash and burn, but it just seems like the end of day advance on the Friday session is not to be trusted yet. I'd be a little hesitant to trust that in terms of just massive follow through in the upward direction. My first thought is to say, okay, let's let the Monday session simmer off. If we open on some sort of gap up, I will not be chasing that. Could it look like a dumb move in hindsight to not chase it? Could the market continue to rally? It could, but I would rather protect my risk at the all-time high. That's what I've got for you through the S&P 500 analysis. Let's do the same thing through the NASDAQ. We'll try to make it a little bit faster here now that we've covered a majority of the concepts that we need to understand as we're trading near these levels. Let's go weekly chart here, QQQ, clean drawing set. Much more of a solid green-bodied bar. And we know that tech has fueled this rally in the upward direction. Solid green-bodied bar, very strong close from the buyers at the highs of the weekly range. Bulls on parade. Obviously a higher low and a higher high, and a very strong close completely outside of and above the previous week's range. Much more of a range expansion move in the upward direction than the S&P 500. And I think this is warranted considering that you've got much more of a sideways consolidation here on the weekly time scale. This is like week 1 of the breakout. This is week 2 follow through. So all good when it comes to the QQQ. This doesn't really strike me as anything other than weekly bull flag breakout, and we're trying to go with the direction of the breakout in the direction of the overall trend. Obviously, it's a brand new all-time high, and just like in the S&P 500, there's plenty of room. There's no indication of a pullback looking imminent, but if something were to develop, a higher low could form, and ideally at this point, it's just going to be over the top end of the weekly bull flag. So something that's like 579, give or take. We'll see that with more nuance on the daily chart in just a second. Let's grab the anchored VWAPs on the weekly, all set above the entirety of the stack. No issues with that. We can come in here with our Fibonacci from the low here up to the high. Your 38.2 is the bottom end of the flag, just meaning that ideally you'd stay above. But in the grand scheme of things, like there's probably no problem with something that does this unless it starts to develop head and shoulders and unless we actually take out those lows. If there's a weekly trend reversal, then fine, we'll be all over it. But let's not get ahead of ourselves here. Let's take it one bar at a time. If we fail back into the range, great, we'll have that conversation when appropriate. If we just pull back, I'd say the base case looks something like this for continuation until proven otherwise. We can come in from the low up to the high because there's a little bit more range expansion. I just want to continue to check in on where the 38.2 aligns with the previous all-time high. Not quite there yet, but working towards it. And if we come in with a volume profile, what do we have from this perspective? I just want to see if the volume shelf aligns with the top or the bottom of the range. The top of the volume shelf is the top end of the range. So all set. Once again, something like that 579 spot looks pretty compelling here. 579? My apologies. Yeah, 579, 577, something along those lines. Pretty compelling for a weekly higher low at this point. Let's drop it down to the daily. Let's get a little bit more nuanced and granular with our first look at the weekly expected move. Here we go. Upper edge is up there towards 608. Can you believe that? We're cracking into the 600, 608.90 in the upward direction there. That's a higher high and a brand new all-time high. And here, a much higher low, even relative to the FOMC low, which was still a soft higher low. The hourly trend never flipped to down there. So I'll think, actually, yes, it did. My apologies. I have to recant that statement. I have to retract, that statement on the QQQ. We did get an hourly downtrend because of the way we were positioned relative to the Tuesday high. But point being is that if we were to pull back on the daily time scale from the highest high, the lower edge of the weekly expected move is a higher low. I would love to see a gap fill reversal as a possible daily higher low to continue the trend in the upward direction as well. Straight up continuation gets a little tough to chase for all the reasons we've already talked about, but the trend is up. The trend is your friend, and you don't want to fight it until the trend starts to reverse. On the weekly time scale, remember we were talking about the top end of the balance range. I would say it's probably just the double bottom neckline that I would focus on for a weekly higher low. I know we're looking at the daily time scale now, but try to just mentally think back to that weekly balance range. As long as we're over this pivot, right? Because that was the threat of the lower high. As long as we're above that, which is actually 576.50, so a little bit more nuance there, but that's your weekly higher low, okay? So all set from that point of view. Again, we've covered the gap here. Another thing we would just say about the gap, right, is an unfilled gap after the move higher on Thursday would indicate that sellers didn't do their job. So do we have stronger sellers participating in the market? The answer is no. If we did, they should close that thin structure with no problem. As a matter of fact, all that happened was we used the previous all-time high as newfound support and the market made an advance. I don't know about you, but that precision type hold like that continues to sort of tell me stronger sellers aren't here. Again, stronger sellers, when Uncle Joe calls the brokerage account, manual trade desk and says, hey, can you liquidate my entire portfolio? I see these guys on CNBC telling me that a recession's around the corner. When everybody feels that way and it's mass panic and mass fear and everything, you don't get precision holds of levels. The market will move without regard for technicals. And that is a telltale sign of a big sort of shift in sentiment that probably leads to further downside. And eventually there will be some sort of capitulation, of course, but we just don't have that. So at the all-time highs, I can't be bearish here. I might be cautious of my trade location and putting on new trades. We could throw on that extended indicator here. What did we call that? Distance from 20. Yeah, here we go. All right, what's the distance from the 20 here on the NASDAQ as a normal sort of reference point? Let's just go to the 3-year chart. Let's see what we have. So are we in the neighborhood? Yeah. We're maybe even like towards the upper bound of the neighborhood of extension from the daily 20, 20 points above the daily 20. So we'll see where it lands from here, but would you start to maybe be open-minded to pull back opportunity? Of course. Of course. So let's just remove this guy and let's take it on down to the hourly time scale. And let's see what we can see here. You don't really have the threat of the double top, noting that you did make a higher high on the Qs versus the S&P 500. And that has to do, of course, with the dividend as well as the contract roll for the futures, of course, in the ES as it relates to the SPY, of course. But in the QQQ, you do not have the double top threat. I would say that if this turns into a head and shoulders, fine, left head, right shoulder, neckline break, probably interested. I would take this short. I would probably take this short on a lower high Brigade bolt under 596.30, just noting that there's really thin structure through here. So it'd be probably worth an attempt, but I would have very low expectations, right? If this just makes it halfway and then quickly rallies back into this consolidation, am I shocked? Am I flabbergasted? Of course not. We're trading a very strong bullish uptrend. I think it's worth the risk reward, right? Doing something like this if the setup is clean enough. But it wouldn't really be my first, like, oh my God, this is a plus holy grail setup. I'm going to make my year on this NASDAQ short. No, absolutely not. So that's the first thought there. Any consolidation over 598 is inherently bullish. We look to go with. If there is sort of look above and fail, then again, like when and if you take this out, maybe there's a short. It would have to produce a new high that promptly fails back below. Then you build out the structure. Has to be structured, right? If the Qs do pull back into the gap fill reversal once again, this would be a top priority for me. Do we set a daily higher low near the lower edge of the weekly expected move over the unaffected FOMC price? Gap fill reversal, right? This head of the pattern could extend to look something like this. That would be A-OK. That's 588.35. Really, the name of the game in the market here is like caution new money longs and just be patient and be ready to sort of execute when a pullback inevitably does happen, right? The market's not going to move in a straight line to the upside forever. Let's come in here with the Fibonacci's from the low of the FOMC to the all-time high. Not really getting great confluence out of the 38.2 or the 61.8 from this perspective here. Let's just take that off for a second and come in from this low. I know we didn't do this on the S&P, but I just want to see where this lands. Look at that. I mean, not that you would have had this high marked already, but it's perfect confluence with your FOMC low in there. You can see that on the FOMC right here is that hourly downtrend, of course. So I would call this a daily firm high or low. If the daily chart makes it all the way back down to this area, you could go equal low and probably still maintain a bullish stance, noting that you'd be over the daily 20. The ideal daily high or low, I can't remember actually, and this is on me, if I mentioned it or not on the daily chart, but 588.35, right? In this spot, that's sort of where I would want to see daily high or low be ideal, just in reference to this, which did ultimately flip into, as we made note, the hourly downtrend. Lower high was on the table, lower low, lower low. In the S&P 500, we had an equal high and then this volatile low, but that was it. Okay, there's the QQQ. Let's quickly take a look at the intraday anchored VWAP, see if this has anything for us. Anchored VWAP, this one. We're above the entirety of the stack. The FOMC anchored VWAP is maybe early week confluence with the neckline of what could hypothetically be, again, this is not even close to being guaranteed yet, but hypothetically, head and shoulders, anchored VWAP there, that's 596.30. If price were to do this, again, the gap close, daily higher low thought process starts to take over around this 588.35. Gap close, FYI, is 593 down to 591.60 for those who like to hear it audibly. All right, that is your QQQ. Let's take a look at the NASDAQ side of the market internals. Were they bullish? Were they bearish? Let's take a peek. You can see a little bit more neutral. Sideways here at the zero mark. That's kind of a little bit more reasonable considering that the NASDAQ did make a new higher high on the actual price action, right, in the QQQ. If you look at the AD line, it was lower under the zero mark, not in trend lower zone, and there was a bearish cumulative build. So again, the exchange level, not really great participation as we're cracking to new highs there. I would be a little skeptical of the action from Friday, which is kind of the theme of today's video, just being very cautious of new money longs at the highest highs in this trend count. If we jump on over to the NQZ contract for our market profile, what we'll see over here is a subtle shift in value higher. I'll give a little bit more credit to the NASDAQ side of the market, which we've been doing already. You have an M period spike. You do not have a double distribution. We'll see where we open. Do we open in the spike? Do we open, let's get a squiggly line, open in the spike, above the spike, below the spike? You know spike rules tell us most bullish outcome is opening above on a gap. The market should auction higher in theory, trying to find the next location where sellers are waiting. If we open in the spike, it's acceptance. Under the spike is a rejection of these prices. I would say longs late to the party are feeling a little disappointed. It's very possible you get that rotation for at least a value area low test, if not slightly lower into the low of day from Friday, and then we'll take it from there. Probably pay attention to this A period single prints from Thursday as well. Really thin volume commitment through that. So something to watch out for on the NASDAQ as well. Let's jump back on over to the platform. Let's finish up, of course, our third of the indices. We will take a look at the Rusty Russell on the weekly time scale. IWM, what do we see over in small caps? Nice move to the upside, making a brand new all-time high here. Not closing on it, though. If you just do something like this, you could see we backed off slightly. Nonetheless, actually, as crazy as it sounds, that actually is a brand new all-time high close. The close of that green, yep, that is a new all-time high close. We backed off of the official all-time high, but it was a new all-time high close. Let's remain committed to the process. What do we see in terms of candle structure and location? In terms of structure, solid green-bodied bar, decent-sized upper and lower wicks, although I do still see that the candle body is larger than both. I wouldn't call it overly detrimental in terms of implications from the upper and lower wicks, just a little bit of sell-side pressure on the highs, buy-side pressure on the lows. In terms of the bar-to-bar count, you can see that we have a higher low as well as a higher high and a close outside of the previous candle's range. The trend, of course, remains in the upward direction. We did notch a brand new all-time high, closed at a brand new all-time high, and the trend remains in the upward direction with a clean sequence of higher lows. There's plenty of room. I know this one might sound crazy as well, but if the small caps double top on the monthly, then I would say your first higher low spot is really down here, the top end of this balance range, which led to the breakout in the first place. That level is much closer to about 225, which we've been tracking on the daily. Now, I wouldn't want to see that in 1 week's worth of trade. That's a pretty aggressive sell-side move, but we'll see what happens as and if markets start to consolidate near the all-time high now that the rate cut is in the rearview mirror, right? The market was pricing in a lot of this optimism around the rate cuts for the small caps. So let's take a look at the anchored VWAPs. Let's bump this one up to, what is that, 728. I think if I just throw on the QQQ or the SPY version, we'll have one there. Yeah, so still above this anchored VWAP is here on the weekly time scale. All set, no problem over the entirety of the stack. Really no issues there. Obviously, we have the full 100% retracement now from the all-time high to the April tariff lows. What we'll do now is really start measuring this Fibonacci here. Notice that the Fib 61.8 is over the top end of the range here, confluence near that 225, meaning that on the weekly timescale, should a pullback develop, still really interested in the opportunity for a higher low anywhere over that 225. Let's drop this thing down to a daily chart for small caps here. Let's evaluate this week's expected move, the trend, the whole 9 yards. What do we see out of smalls? So here is the expected move, upper edge, 247.91, higher high, brand new all-time high, lower edge, 238.05. I'd call that kind of a slightly higher low, maybe an equal low. We did have an hourly downtrend here as the market broke down from this little double inside range on the Tuesday session was when the breakdown took place. That was a Monday inside candle earlier on in the week. So what do we have noting the overall trend though? I mean, there's still plenty of room, right? At least early in the week for the possible hold of something like 240.50 to stay over this previous pivot high and offer a daily higher low. If that's the case, then guess what? Great, the trend remains up and we want to continue to trade this. I mean, we could try a trend channel here. I'm not really fond of trend lines. You guys know this. But let's come in from here. Let's just see how steep this is. I think it's more of a rising wedge. Yeah, you could probably come in here with an angled trend line top, do something that looks like this, and call it a rising wedge. Anyways, trend lines really aren't for me. They're a forecast of the rate of change and the pace of acceleration. I don't know why you would do that. You should really just focus on horizontal levels where positions have been proven to been held, right? So anyways, rant aside, as long as we're over this 240.50, I would say that we're good to go for a higher low, looking for continuation in the upward direction. If we drop underneath that, okay, now maybe we start to build out the possibility for that classic head and shoulders, and I would say that there's a very clear neckline. That would be here at 235.15. It's a level that we've carried forward for quite a long time now, the last week, 2 weeks. If we crack underneath that, really from all of these equal lows back here, I think the door is open for a stronger weekly pullback too. Lo and behold, there's that 225 spot, top end of the balance range from back here, right? So it's very clear how the path may develop to get that weekly pullback, but what's the name of the game? Let's not jump the gun here. We have 1 day of red activity off of the gap up to a brand new all-time high. There's plenty of room and reason to believe that we might get consolidation here and continue along in the upward direction. A trend is a trend is a trend, and it's your friend until proven otherwise. If we start to get acceptance under 240.50, if we start to see daily lower highs emerge, fine, we'll change our tone. Maybe we get that weekly pullback, but we are not there yet. Let's take a look at the hourly time scale. Let's see what's going on here. There's a lot of volatility on the FOMC, specifically in small caps, but what I found most interesting about this is there was actually a weak close on Wednesday, right? Wednesday closes here, unchanged basically from the opening print, whereas the ES and the NQ basically closed a little bit higher. So your unaffected price ahead of FOMC was here, and you closed below that, whereas the ES and the NQ again were above. So the fact that Thursday already rallied to take out the FOMC high, made a higher high on Friday, and is now just pulling back gently, right? This is not Armageddon-style volatility on the pullback from Friday. I still can't really maintain a bearish stance here. I think that the hourly trend may flip to down via this lower high. And if we get a lower low, as soon as that happens, like on Monday perhaps, if we take out Friday's low, we'll have an hourly lower low. And it's very possible that coming into this level right here, you start to set your daily higher low. So is there a 1 hour trend reversal, excuse me, off of 240.50? That would be the next major question. That's really as simple as you can make it here in the small caps. Let's come in from the FOMC range to the all-time high. Fib 61.8, right on the money with the line in the sand. All set from that perspective. Intraday anchored VWAPs. What do we have here above the FOMC anchored VWAP? Oh, here's a possible trade, right? Let's say you look below and fail on that anchored VWAP. Any acceptance back over the FOMC high in here at 243.25, bulls back on parade. I would not think twice about being a short there. I would more so try to go with this trade over the all-time high previous, all-time high level at 240. Let's call that 245 for round number sake. That's a possible trade idea should the FOMC anchored VWAP hold. Okay. And if not, look at where the cluster is underneath us, 240.50. It's all right there. Confluence, beautiful, right off the levels. Let's come in here with the Russell market internals. What do we see out of the exchange? It's really the index level participation. Strong volume outflows. Advanced decline line is weak and a bearish cumulative build. So a little bit more bearish and a little bit more straightforward considering the gap up that faded, and it did close red here instead of green like the S&P and the NASDAQ, but you're getting that bearish pressure here from small caps. It's not a surprise to see that sort of narrowing of breath after the euphoric rally from the FOMC. Let's jump into the market profile for the Rusty Russell. Let's give this a little reset. Let's really reset it. There we go. You can clearly see value lower, liquidation break in A period. I don't think there's anything here that's overly compelling for, massive short, but it just looks a little bit more bearish than obviously your ES and your NQ, which is not much of a shock, right? There's a poor low here, which is confluence with the value area low from Thursday. That's a mechanical level. If you were to start testing Friday's low in the Russell, I would expect it to break. I would expect a break, probably retracing down towards A period lows of Thursday. And what is that confluence near, right? Right here. That's your daily higher low that we just talked about on the IWM. Right, that's going to be roughly around 2440s in your RTY, and going back over here in your IWM, it's right here at 240.50. So all set, makes sense. No problemo here in the small caps. First thought, base case, trying to navigate the bulls. If we start to fail underneath, we'll become a little bit more neutral. If there's going to be a reversal, fine. We know how it shapes up. We just talked about it on the dailies. Let's reset this and start to do a quick sector tour, see what's going on with our S&P sectors as we come barreling into these highs with a bullish inside bar that's divergent at the exchange level. What do we see in terms of weekly performance? Semiconductors leading the pack, SMH up 3.92%, followed by tech, communications, and industrials. Financials also outperforming the S&P. The bottom end of the barrel is real estate, the bond market, staples, materials, and we'll go one more since bonds don't really count. We have, I'm just trying to make sure my vision is correct, that's healthcare, XLV. XLU utilities underneath that as well. So in terms of risk posture, it certainly seems more risk on as opposed to risk off. Let's check in on the structural charts and see what's happening here. SMH looks absolutely phenomenal, and you might be like, well, I thought NVIDIA is lagging. Just as a reminder, I mean, NVIDIA is the top dog in the SMH, but it's followed by TSM, AVGO, MU, AMD, Lam Research is in there, ASML had a huge gap up to end the week, Intel, obviously, huge component. So with all of this stuff going on, it's not really a shocker to me that SMH still remains strong, even though NVIDIA on a relative basis might be trading like down here relative to this structure, right? So all set on SMH. Obviously, NVIDIA has its own issues, and we'll talk about that technical chart in a minute. But as a theme, as a sector or industry, subsector, sub-industry of the tech sector, there we go, this is bullish. I mean, there's nothing wrong with this chart here. Even if it pulls back, right? Fine. Again, caution, new money longs at the highest high here. If this pulls back and closes the gap fill reversal nets a higher low. If it overshoots the gap and still tests this previous high and supports at 303, higher low. So no issues in terms of structural trend here on semiconductors. The bullish base case remains alive and well. If you look at the XLK, brand new all-time high, I think the chart speaks for itself. If it consolidates, if it continues, if it pulls back, all of these things align with the daily trend remaining up until there is a threat of a lower high that looks like this. Let's not forecast, let's react. Or what could we say? Let's not predict, let's react. As of right now, the trend is up and there's no threat. Let's take a look at the XLC. Communications, a little bit of a balance range rather than, excuse me, a little tight in the chest today. A little balance range rather than continuation in the upward direction, like what we saw in the XLK and SMH. But Still, where's the location? It's at the all-time highs, so I still can't really get bearish here. And again, even if it pulls back, is this not just a great spot for a higher low when and if the daily 20 starts to catch up and provide confluence? Seems to me like that's a pretty decent shot there at 115.65. Let's move along to industrials. Let's take a look at what's happening here. You've got yourself a balance range, nothing to talk about on that. Financials, trying to break out. This has been a little hesitant to really get accelerating over the previous all-time high at 54.10s. I'd be a little bit more neutral on financials here, just noting the way it's struggled, again, over that 54.10. There's nothing here that says the trend is about to reverse or, oh my goodness, it's the worst thing in the world, but you've seen really lackluster attempts up here, and it's not so much the banks, it's things like MasterCard and Visa that are lagging on here. So if you fail back into range, I just maintain a little bit more of a neutral stance. The reason this is important and it's worth talking about is because it's the second heaviest weight sector by market cap. So please respect financials for what they're worth. If we take a look at real estate, not much going on over here, midpoint of the balance range. Let's take a look at the bond market pulling back, which you might be like, I thought the Fed was cutting rates. Well, they did, and that was massively priced in already, and now the bond market's cooling off a little bit. So generally, I think that interest rates have bottomed. Like the 10-year, if I think about the TNX, 10-year probably bottomed at about 4%, noting that the FOMC SEP basically outlines that the Fed funds rate is going to bottom at 3%. You can't have a Fed funds rate at 3% and a 10-year rate at 4%. I mean, what are we doing here, right? People on the 10-year side are going to be like, why would I try to get an extra percent for how many years of holding versus a 3, like let's just call, the equivalent maybe of the Fed, the 3-month, right? So just, I think that there's a lot of disconnect here in the TLT. I think that this should come down a little bit, hypothetically. I would be interested in some put sales on this if it aggressively comes into this range, maybe some put sales underneath this 85 spot, if implied volatility can spike. We'll see. Anyways, continuing along back to sectors, XLP, staples, breaking down from this balance range is a little bit more bearish, and I would start to lean into this thematically as a story and the state of the consumer. Is the consumer not doing well here? Is there going to be a big hit to corporate earnings? I mean, if the XLP breaks down, it is D for defensive, right? It's consumer staples after all, but it's not really what you want to see in terms of the health of household balance sheets. So watching the XLP here weaken a little bit underneath 80, a small red flag, but it's not enough to short the market. Let's take a look at materials. Not much to talk about in here. When and if it breaks out, that will be upward pressure, but that's when and if. Neutral for now. XLV, neutral for now. Failed breakout, but still staying over the moving average, the 50, and leaving the gap unfilled. So kind of neutral on that front. I'd say generally the failure to go higher probably makes a little bit more of a bearish tone here, but it's just, it's not the opportunity zone for trading recently. And we'll talk more about this as we go through the core list of companies, because there's been a very clear shift, and I think it became the most obvious to me over the span of last week. Anyways, utilities, you've got yourself a small uptick happening here. It's D for defensive. I think it's neutral. I think it's fine. It's not really a threat to the bullish base case. If we look at the discretionary sector, we are just putting in bullish consolidation on the highs, basically over the previous all-time high. I don't see any issues with this chart in particular. Again, like many other things we've covered, even if it pulls back, can we set a daily high or low here? I think the answer is yes, and the trend remains up. If we look at energy, a little bit of a double top, failing into the gap once and twice now. Neutral, though, inside of this range. If this does back off and just remain in here, I mean, energy underperformance will just help the Fed on the inflation fight to some degree. So that is energy there. Let's take a look at the ratio charts, because what we'll see in the ratios is very similar. There's really no threat here. We know that financials continue to be the iffy one, but we still have 3 out of 4 bullish check marks here in the risk-on sectors. We don't have any risk off here, no risk off here, and no risk off here. If we go to the specialized sets, over in the ABs. And by the way, if you're not familiar with how to set up a ratio in Thinkorswim, we've got you covered with a tutorial. We're shooting 6 for 6. We're looking good. Uptrends across the board here on the risk-on sentiment. So hard pressed to say anything bearish from that point of view. Again, being mindful of trade location. Could the market get a little bit overextended here? Sure, but it's not bearish. If we look at the GCs, the gold ratio, it's starting to cool off a little bit and go sideways relative to this major advance here. I'd say that the TLT ratio is aligning with no flight to safety taking place. Bitcoin started to produce a little bit of a failed breakout into the end of last week. Let's actually go on over to this chart here just to take a peek at this on, let's go to the daily chart first. Let's just bring this down a little bit and let's take a peek. So hypothetically, if this was really going to start going and continuing to align with a big risk on opportunity, would have wanted to see this balance range breakout be successful and try to navigate back to the all-time high. I wouldn't call this a failed breakout in the sense of, oh my god, it's going to crash and burn, as long as we're over the neckline of what you could probably construe as an inverted head and shoulders on something like a, if you look at a continuous chart of the spot price of Bitcoin, not the futures chart here, it's definitely an inverted head and shoulders. You could look at an hourly chart. Your neckline there is around 113,850. You could call it 114 if you like nice round numbers. As long as you're above that, I wouldn't really have a big bearish tone here on Bitcoin. If it fails it though, okay, now all of a sudden we're dealing with a major lower high. All it's going to take is a lower low, and I think you get a little bit deeper of a pullback, possibly towards this area on Bitcoin over the span of time as a potential risk-off signal. We're not there yet, but it is something that I would carry forward if this big neckline starts to fail. Once again, 114 would be the nice round number to use. Let's take a look at the dollar and interest rates. And what you can see here, actually, let's go to gold before we go to the dollar and interest rates. My apologies. Let's go here. Gold is starting to perk back up in, obviously in the upward direction. And I'd just be watching to see if it can continue the breakout here. I would think it wouldn't. If gold tries to crack a new high and then comes in, I'm actually, as crazy as this might sound, I might be interested in a short on gold here, and that's been the case over on the GLD here. So you can see I have this alert. If this cracks a new high and fails again, because that kind of happened here, right? You see how it made a new high and came back in. I think the gold run might be in need of a little bit of cool off, and I'm just sort of tracking this neckline in here around 330, 335. So not a big bearish position. Oh my god, I'm going to hold gold shorts until this is back at 300, but maybe a quick scalp to the downside, or a multi-day. Maybe we'll structure it as a credit spread to some degree, some sort of some sort of a net short premium sale, right? Options trade on gold. So just kind of interested in that over the next little bit here, seeing that in my view, we've sort of run our course with what's happened in the pricing in of the Fed rate cuts. So now we can go over to the dollar and rates, and this might make a little bit more sense. If the dollar is going to perk up now that rates are possibly, have hit their floor, so to speak, at 4%, again, put the pieces of the puzzle together. If the dollar is moving higher, that's likely putting downward pressure on gold. Right? So I'm sort of paying attention to that on the relationship between the two, if that trade is going to fire off at some point, watching interest rates holding the floor there again at 4%. The exercise that we've been doing is, right, if you sort of think about the spread between the 3 and the 10 year, or the 2 and 10, 3 month and 10 year, these things sort of have about a 2 to 2.5 percentage point distance between the two, and we're just not there yet. So once again, as we said, and we could even just go over to this, let's take a look at, we don't need the inverted ZT, but what we can do is just jump on into this. And unfortunately, actually, I should have had this preloaded. Let's go to the SEP, and this should bring this up. Let's go down here. SEP, here we go. So what I'm talking about is the Fed funds rate. You could just use the longer run projection of 3% even. If the longer run projection is 3% and there's normally a 2% spread between, you could say the 3-month and the 10-year, then add 2 to that, and that gives you a 10-year at more like 5%. So I don't think that the 10-year needs to go to 5% right now. But again, if this moves higher and this moves slightly higher, right? Probably talking about gold coming in a little bit. Anyways, that's a little bit of thesis there. Sorry for switching the screen so much. Let's go to the Fed tracker tool. Speaking of the Fed and what's happening there, you've got about 375 by 400 basis points as the projected next move, which seems very reasonable considering how Jerome Powell spoke through his speech there, really saying that it's time to change policy stance to the incoming data, really being a little bit more concerned about the labor situation. What I find a little bit interesting in hindsight, reading back through it, is Jerome Powell was very confident when he said, as a matter of fact, we actually expected almost 1 million jobs to be revised out of the NFP, and yet they waited this long to cut rates, is kind of the interesting dilemma, right? If you're expecting that many jobs to be lost, then why were you not cutting rates earlier if you knew that the labor market was going to soften more materially than you had originally seen in the incoming data, right, before the revisions? So that was a little bit of a head scratcher, and that to me seems a little bit more hawkish than maybe the meeting was interpreted as, right? Jerome Powell was basically willing to keep rates higher even though he knew the labor market with revisions was going to be softer. So that's something to maybe parse out just a little bit. We do have the new Fed board member Miriam, who on the dot plot was just totally off in his own little world here, dragging the average. If you take a look back at the projections table, let's go back up here, bringing this to a 3.6. If you didn't have Miriam, you're probably talking about something that's still, a 3.9, if I'm being honest. So with that said, interesting times with the Fed. I don't think the market really cared much about the FOMC or any of the decision-making calculus that was there. I think the market got the 25 basis point cut that it wanted, and it continues to see that, yes, more cuts are on the horizon, and there's really no change in that. What we also find kind of interesting is that the unemployment rate projection is unchanged, but yet Jerome Powell, once again, sort of made note to say, yeah, we sort of knew that the downward revisions were going to come in. We still see downside risks, but yet you're not changing your projection there. I don't know, just a bit of a head scratcher. Probably, of course, I guess not wanting to spook the market and scare people, leaving it unchanged there. So that's my commentary on the Fed. I think that price action rules all, and the ES and Q are obviously higher after it, so it doesn't really matter if you thought it was bearish or bullish. It just was bullish, and we're a little bit cautious now at the highs, noting that the big event is now in the rearview mirror. As we look forward on the economic calendar, there's a lot of Fed speak early in the week upcoming. You can see that they've stacked the calendar here into afternoon on Monday. So maybe be a little bit interesting to see how Miriam, again, that's Stephen Miriam here, the new Fed member, see how that conversation goes and how dovish he actually leans. I believe there was a quote. I'll see if I can find it and maybe post it up on the screen here. But I think Miriam was talking about massive rate cuts into the end of the year. And there was a Twitter post about that or something, or one of those Bloomberg guys was retweeting it. Anyways, point being is that the Fed speak's going to get interesting now with a new member there. PMI's flash side will be fun on Tuesday morning at 9:45. Be aware of that. Powell speaks at 12:35. What event is this? Looks like some luncheon in Rhode Island. Okay, the great home state of Rhode Island. Awesome. We'll maybe stream that live up here in the office. We have GDP, jobless claims, durable goods, home sales. PCE is the big one on Friday, but I think the market already has enough data from CPI and PPI that the market won't really care about that. So a pretty interesting week in terms of Fed speak and a little bit more Fed information. Your PMI is probably the next largest issue to pay attention to. Jobless claims last week came in better than expected and well back underneath that 250 threshold. So I'm actually pretty pleased with the way the fundamental and economic data came out. With that, we'll move into the earnings calendar. Not much to really talk about here. Maybe Micron after the close on Tuesday worth paying attention to. Costco worth paying attention to on Thursday after the close, but that's really it. Let's get back on over to the platform. Let's finish this on a strong note. What do we have out of the bond relationships? You could see that this has started to bottom out a little bit, primarily focusing on the long end, just to get a sense for how the market's continuing to think about the nasty I word, inflation. If we take a look at, let's jump into credit spreads, they continue to drift in the downward direction, which is bullish for risk appetite. If we look at junk bonds in isolation, they're still elevated here. A little bit of divergence with the LQD. This could be a small white flag to tap into as well if you're trying to navigate a pullback or at least be super cautious of longs at the new all-time high. You could carry this data point forward as being supportive of that sort of mentality. Let's jump into breadth. Breadth has a little bit of a contraction on new highs versus lows to end the week. A little bit here on the 200 SMA chart. 50 SMA chart is flat. If we look at something like the RSP, what we'll see is a little bit more of a concern, right? It was unable to, both on the Fed as well as the continuation into the end of the week, make a new high relative to what we have here. This would align with the bearish market internals that we were just seeing. It was not a broad-based rally on that end-of-day move from Friday. It was really, just concentrated in some of the, do we even want to start talking about Oklo, the nuclear stock, up something like 20+% on Friday, right? So there's some pretty nutty moves happening on Friday, but broadly speaking, it wasn't really enough to make a difference at the equal weight exchange level. The one thing I will say that sort of stands in contrast to this a little bit is that the NASDAQ equal weight did make a new all-time high and closed right on it. So a little bit better than the S&P side of the market, but this would make sense considering that the S&P is being led by tech higher, but then all of the other 10 sectors, right, that are not the XLK are the ones that are sort of not participating. Remember, when we looked at the XLC, it was more so just sideways up there at the highs. So that is the talking point there. It's a little bit of a breath issue, right? If we look at the volatility index, no real talking points on VIX. If we take a look at the VVIX, which is volatility of volatility, big crush on the FOMC, not a shocker over there. And the one-day VIX did the same exact thing, completely rolling over as Jerome Powell's commentary started. Just, one-day VIX collapsed, and you had a mechanical rally in the S&P off the lows of the session. The what am I trying to say here? Posture. The term structure posture is in a contango, and we have updated this post-VIXpiration to also reflect the latest contracts here. We are in contangos across the board, which is bullish for risk appetite in equities and money managers allocating capital. Let's bring this back on over, and let's take a tour through our core list of companies. Here's NVIDIA. Remember, the SMH on a relative basis is like up here. NVIDIA is lagging behind. As you can clearly see, you've actually got a sequence of lower highs starting to develop on NVIDIA's daily. But you also have this higher low. I'm actually kind of neutral on NVIDIA right now, not thrilled about where it stands in terms of price action. I think on the hourly chart, right, what would have been like the only thing that made most sense was if this inverted head and shoulders neckline could act supportive. It did. That was FOMC, of course. And then this recapture, right, this really could have been a rejection lower high, first thought, because you have highs, lower highs, lower highs. You're also coming up from the bottom, from a major gap down. So, and this is the China news, right? That's like, hey, we're not going to buy your chips anymore. So all things considered, the NVIDIA chart leaves probably, for me at least, more questions than it does answers. NVIDIA has not been one of the hot names to trade recently, at least for me. I mean, you guys can trade whatever you want to trade, but for me, it has not been a top trader recently at all. And in this box, I'm just not interested. If we do something over 179, maybe this thing straightens out back towards the all-time high. If it drops this, I don't know that I want to be short into this low. I think more preferentially, I would just want a new trade structure to build out. I guess you have overhead supply if this is the case. Overhead supply here, this lower high could be a short. But it's a very odd chart to me right now with kind of competition between the time frames, right? The hourly doesn't really look good in here. You can see it's kind of trying to accept back in this range. Maybe this turns into the next inverted head and shoulders, but what would that require? Over 179. So NVIDIA is not a top priority for me right now until new chart structure builds out and would suggest otherwise. If you look at Microsoft, really funky end of day rally happening here. I was not at the desk for that. I hope you weren't either at, 3:30 on a Friday, but what's it leave us with? I mean, we've broken out of this base. After this, attempted to go head and shoulders. No break of the neckline. This is over the right shoulder. I would become a little bit more neutral now on Microsoft. If we go back to the daily time scale, the reason I would have been bearish, at least on the first head and shoulders attempt from the hourly, is because of this. Previous support now acting as newfound resistance. Now that we're accepting in this range, maybe Microsoft plays the catch-up trade and is over 518.50 to get back in gear on the long side. So we shall see. I don't fully trust this end-of-day move here. If it does pull back, I think what would prove it is if we can support over the morning high at 513.75. Let's take a look at Apple. iPhone sales apparently booming. A lot of people bullish on the iPhone 17 release. There's your pie in the sky inverted head and shoulders. I was watching 240 quite closely. There was a nice gap fill reversal there and continuation into the afternoon. So walking forward from here, I think now it's the precision hold of these highs, considering it was the opening print of Friday. As long as the pullback stays over 241.25, seeking a higher low and continuation out of Apple's, dare we call it, cup and handle here, starting to get liftoff back up towards the highs. Is Apple back to being an innovation company? I don't know. I feel like if I had picked up an iPhone 17, it might bend in my hand, but hey, I guess the marketplace loves it, and we can't fight the marketplace. So over this 241.25, I think we should go with on any higher lows that stay above. The issue is, as you can see, it's only really worth trading on the catalyst day. So iPhone sales day, look at the volume that came into this thing, probably worth watching early in the week, but if there's more new headlines over the weekend, like, in terms of dollars that were brought in, like you see some big report that says Apple made blah, 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 $1 trillion, as much as the quad witch expiration on their first day of iPhone sales for the iPhone 17 globally, and it's absolutely knocking it out of the park. If there's a catalyst, then great. We'll look to go with a little bit more confidence. But if there's no new catalyst, if it just kind of fizzles out a little bit, you're going to get that crummy price action on Apple that you typically get slow. Let's keep it moving. Let's take a look at Amazon, but only for about 2 seconds because this is an absolutely horrific chart. There's nothing to do here. This price action is abysmal. Amazon, it could perk up. It's got to prove something first before I start getting really interested in Amazon. These are terrible looking bars, tangled at the 20. Yeah, you have higher lows that are building out like this, but you also have the failed weekly breakout from back here, and now a lower high back in range. I need to see something better before I commit more time to Amazon. If we look at Google, this is beautiful. Nice uptrend happening here. Beautiful break over these candle highs. A little bit sluggish into the end of the week, but nonetheless, the chart structure still aligns with the buyers remaining in control. If we take a look at the hourly time scale here, you can see that consolidation, upside lift, blue sky territories, pullbacks over 250, 215, Brigade bolt back over the 254, upside blue sky territories. The only time I would really start thinking short on Google is if it builds out one of these guys. You guys know the deal. It's not a head and shoulders until it is, but underneath 248.40, level probably needs to be updated to here, 247.85. But as an illustration, right, here's something. As an illustration, you opened in range after failing to go higher here. Very nuanced, but that's a failure to go higher, right? Market takes out these consolidation lows. Does it accelerate? Does it close the gap? Survey says no. What does that mean? We don't have stronger sellers here in Google. Absolutely not. So updated neckline would have to be something like 247.85 to take this low out to then close the gap, but we have to get there first. We have to produce a lower high underneath 252.15. Let's move along to Meta. Meta has started to get a little bit cleaner, but Friday kind of throws a wrench in the mix. I was liking the breakout over the 2-day high into Thursday, 780.85. Friday says no thank you, back inside of this range. So back to being a little bit more patient on Meta than anything else. Rough trading in here. The Mag 7 has not really been where the core opportunity set has been recently. Palantir, the Palantirs of the world, the AMDs of the world, the Robinhoods of the world, the Oklos of the world, these things have been the opportunity set, not these. But, obviously, as still the heavyweight companies in the S&P 500, it's worth continuing to watch for. So Meta, the trend is not down, but it's a very, very difficult trade these days to pull this off and actually make something nice happen there. Let's take a look at Tesla. Tesla's been a good trader on this breakout here, and I think it's going to, after this consolidation, the next leg here, be it up or down, doesn't matter, will be very lucrative to trade on Tesla once it finally makes another move here. So the consolidation is high and tight post rally out of the weekly breakout level there. I'd be very interested in gap fill reversal longs on the daily time scale, or if it breaks below that, probably thin structure retracement. That's way overshoot on the arrow, but we should be targeting this 365 previous weekly breakout high. If you get something that looks like this, there's your pullback into the level at 365, and that's possibly worth a short, right? If you're going to have a down 7-8% day, probably worth it on Tesla to try to participate. If you're up here and you just get a Brigade bolt over 429, be mindful of this previous rejection high at 438.75. Let's zoom out so you can see that. That's this. But then beyond that, it opens right back up into something like 466.25. So you're probably talking about some crummy days in here, but then once it clears it, that's where you're going to get another one of those 7-8% days in the upward direction, right? On the hourly chart, you can see that it's been a little sloppy ever since the advance. I don't really think that battling Tesla in here is the best idea. We all know that Tesla has, a number of days where it chops you up, chops you out, and then you get that one follow-through day that makes it all worth it. Try to avoid as many of those chop-up days as you can when it's just balancing in this range here. So I'm going to parse out, okay, this is bullish in the upper third, it's a bit more neutral in the middle third, and it's a bit more bearish in the lower third. Gap fill reversal would keep me bullish, right? Those are the ideas that I'll really try to implement here on Tesla as we walk forward, and those are the levels. Really getting over to 429, starts to get this interesting over 438.75, which unlocks that larger upside. So being patient, I like the consolidation. I like the fact that it's still also producing higher lows. If this breaks on a really snappy flush, gap fill reversal, if it does this, then we'll be ready to participate through the thin structure. And if it starts to go in the upward direction, I would just want the clearance of 438.75 to really open the door for much more runway ahead. JP Morgan financials look great. Again, the banks look great. It's that Visa and MasterCard that don't. Still bullish here, trading up towards all-time highs. No issues. Let's take a look at Palantir. Another beautiful opportunity on Thursday. It was beautiful. Even on Friday, we had to be patient on Friday, but it was a nice opportunity there. Overhead supply could start to reject here on Friday's high. If it pulls back, the green zone is where I'm interested in the first higher low long. It's a little arbitrary in this thin structure, and now we have thin structure here as well. If we go deeper than that, obviously it's the top end of the multi-day breakout at 171.25 for a daily higher low. You already have the hourly higher low intraday on the move from Thursday morning. If you take a look at the little green zone here, you can start to see how the opening print of that Friday session, as well as what I would consider the breakout point into the end of day from Thursday, that's the sweet spot. If you can come into this and hold, we're good to go. If you fail the breakout point from Thursday afternoon, that's where I would think you make it all the way back to that 171.25. So watching for pullback longs here, right? Maybe that looks something along these lines. If we get here, we consolidate and then break. Maybe there's a short from A to B, but at point B, I would certainly reevaluate and try to pick up longs off of 171.25 for the retest of these previous highs back there, right? Daily Brigade Bolt would be the idea in force. If you just get high and tight consolidation, I would let it be in sort of this thin structure, and then when and if, like it pops out of an arbitrary high or low, over these highs, 183.75 targets the all-time high, and then you're in blue sky territories. Pretty straightforward on the upside there. If we look at Broadcom, I'm not too fond of this chart right now, actually. You can see on the daily, you failed to go higher here, but now you're just back inside of the earnings gap up range. I don't love this. You get a little bit of a hammer look on Friday. Maybe it's higher into this level to retest on the hourly for a Brigade Bolt, like call this inverted head and shoulders. Over the neckline, maybe gets you to that 356.25, but I don't really see it as to me, it's not a top priority. It also trades a little bit more spready than I'd like on AVGO. Let's jump into AMD. This one is also needs a little bit more information. If you've been watching AMD, then you know darn well that 158.50 is a magnet. It's like a fly attracted to the light. It can't get away from it. So 158.25, I need to see some sort of break away from really this now as a balance range, right? You have highs, equal highs, slightly lower high there, but you definitely have equal lows on the bottom. If this was going to continue the daily downtrend more cleanly, probably wanted to see a better lower high underneath the 2-day low from here. Daily lower high, right? On the gap down, gap fill reversal, keep prices low, start to continue. Didn't happen. So like a fly again, attracted to the light, you're just at 158.25, and you need something away from that. You need to get away from that level. So consolidation here, I would really just let it be. I don't want to execute on AMD in this range. I think that if it's going to break down, this is fine for a thin structure retracement under 155.40 into the gap close. That's fine. If it starts to move higher, I don't love it trying to long into these highs. I think the better long is just out of that daily balance that we just outlined, which is here. So let it be. Let it build out the bullish pressure, and then this is the trade, right? Look at the thin structure from back here. It's over 163.65, targets 169.50. Let's move along to Robinhood and see what's going on with the daily chart first. Brand new all-time highs on Friday. Blue sky territories await us above. There's nothing to say here other than bullish consolidation above the prior pivot high. Blue skies continuation. If we pull back, like gap fill reversal in this level would be of interest. It's bullish until proven otherwise. That's really the name of the game here. If this is going to turn into a larger downside trade, I would need to see the all-time high fail, and then I probably would just want to see it underneath 114. We had talked about 114 quite a bit back over here, and sellers could just not get the job done. The tone, of course, remains in the bullish direction. Again, maybe under 114 after failing the all-time high. Maybe we build out a daily head and shoulders or something of the like. You have to crack the neckline, then maybe it's the gap close, but we're getting way too speculative for that. There's nothing on the chart that says that that is a high probability outcome as of right now. High probability is just consolidation, Brigade bolts into blue sky territories, monitor for continuation as you're reaching new highs. Let's get into 5 additional ideas. First on Coinbase. Let's go from Robinhood to Coinbase. It's an easy transition. What I like about this, is the inside candle in the upper half, 50%, of the Thursday breakout. You could also see it over the daily 50 SMA. What I also like about Coinbase rather than MicroStrategy, which is now just strategy, is that it's not just tied to the crypto move, the Bitcoin move, the Ethereum move. It's an exchange, right? So you're going to get more of that transaction cash flow for the business itself, not just increased trading activity when Bitcoin goes up or down or whatever. So there's another component to it rather than just being like a version of leveraged Bitcoin. So that's number 1. Number 2 is the hold of the daily 50 in the top end of this range. There's a gap to close above. If we're going to close that gap, consolidation that remains over 337.25 probably looks compelling for the upside. If you take it on down to the hourly chart, very gentle pullback in here, not aggressive red-bodied bars. Your breakout level is up there over 351.90s. If you can crack it, that's probably where you're seeking upside. So let the bull flag consolidation persist. You could, I don't like the trend line break, but if you wanted to front run it, you could get the trend line break. I would prefer, let me speak for myself. I would prefer to take this trade over 351.90, okay? That's Coinbase. That was up first. Let's move along to RCL. Can you believe it? Royal Caribbean? My goodness. It was actually on a tear not too long ago. Look at this entire move in the upward direction. Very strong stuff. Notice this bullish outside hammer engulfer. Big volume. Just very interesting candle. Perfect high up against this red candle's high there. If we're over 329, I think we could get thin structure retracement through this breakdown. Let's take a look at the hourly chart. Notice how straight this is to the downside. This is a multi-day range now. And again, big failure to go lower on Friday morning, rallying into the close. Over 329, seeking daily 50, Brigade Bolt here, seeking daily 20, Brigade Bolt here, seeking the last pivot high, 350, 325. That should be, you guys know me, round numbers only on that. So there it is on RCL. I like the thin structure retracement. I don't really think that it fits thematically into the market right now, but the candle setup is what really caught my attention along with this breakdown. So that's RCL. Next up, CrowdStrike, CRWD, not CoreWeave, CRWD for CrowdStrike. There we go. I don't know if it's in play yet. The reason I say that is because you had huge volume on Thursday. You sort of tapered off on Friday. And what I find a little bit not concerning, like, wow, it can't do anything and it's game over, but just, I don't know if it's ready yet, is that it looked over Thursday's high and then closes back inside of Thursday's range. What I think I'm watching for on CrowdStrike is if we can take this set of highs out at 514, which, if I'm not mistaken, is just the all-time high. Yeah. So over the all-time high, blue sky breakout. We've seen some things get really nutty these days. I mean, I'm talking about quantum right now. I'm talking about nuclear theme. You're seeing some really nutty moves. I don't know exactly what's going on behind CoreWeave here. I will never claim to be the most in tune with the fundamentals. I'm sure we could fire up the news tab here and see, where's the gadget button. Let's see what we've got. Live news, CrowdStrike, top customers, neutral on the rating, biggest movers basically. Point being is that I'm sure there's a catalyst on it. If we can see it in the headlines, if there's a new catalyst on it in the morning, headed into this upcoming week over the all-time high, I would be interested in possibly watching it for one of those blue sky breakouts. CrowdStrike, worth a watch. People have it on their radars. People are trading it. There's a lot of volume flowing through. Let's see if it can make a nutty move over 514. That would be all-time highs. Let's continue along to Qualcomm. Qualcomm's a little bit more respectful. I'm actually just going to reset this so the news is off there. Qualcomm, there we go. This is much more respectful in the sense that we have this clean breakout level at 163. If the market's going to offer a classic Brigade Bolt, it's probably worth paying attention to, and thematically, it fits the bill as a semiconductor. So 163 is a top watch on Qualcomm. Here's your hourly head and shoulders. There it is. Call it a mosquito pattern, actually. Look at that proboscis. Lovely. If we crack the neckline, look for the pullback. I wouldn't short the pullback. I would look for the long off of 163 to then rotate back in the upward direction. This is a massive balance range, which actually had a failure to go lower and is now trying to accelerate with the theme and the cohort overall. If it can get continuation, I think there's a little bit of an opportunity here on Qualcomm. Finally, one more for you is MU. Micron Technologies, another one hot in the news right now, and just up and away in terms of the way it's moving. It's got earnings this week, which is why it's the last trade idea for you. Be a little cautious of the options premium ahead of Tuesday, and Tuesday will likely change this, but look at the perfect gap fill reversal on Friday. Over Friday's high, I would start looking for a move to retrace back up towards this, the consolidation lows of Thursday. So let's just throw that on with a round number, 168. That's over 163.35. Brigade Bolt over that Friday high into the lows of the consolidation here. Thin structure on the move higher, looking for that move early in the week. It could be a Monday trade. Again, be cautious of your options, the implied volatility, the spread. You're going to get, you're going to be paying a pumped up price there on the premiums. So be cautious of that mechanic, but the trade setup alone by itself here looks really strong as a gap fill reversal over these previous highs before the breakout on Thursday. That's what I've got for you in today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. As always, we will be live every morning like we are every day here on the channel at 8 o'clock Eastern time for another episode of the Pre-Market Prep. Come on out to the show. We'll probably live stream Jerome Powell as well at the 12:35 time frame, was it, on Tuesday? So check that out this week also. Of course, if you want to trade live with myself and a bunch of other really skilled, talented traders, check out the links down below in the description. The live squawk is what you're looking for there. With that said, have an awesome rest of your weekend. Have a green trading week. And as always, I will see you in the next one.